Hello, we are from Queen's Actuarial Consultancy and we are here today to present the basic summary of our XYZ pension scheme to you. The scheme has 968 members in total, and as you can see from this pie chart, of all the scheme's members, 35.5% are actives, 38.3% are deferreds and 26.1% are already pensioners over the age of 65. This graph shows how the actives, deferreds and pensioners in the scheme are divided between male and female members. Of the 344 active members, 150 were female and 194 were male. 193 of the deferred members were female and 178 were male, and of the 253 pensioners, 92 were female and 161 were male. These are the pension increases we decided upon for members fitting into each category. If a member belonged to Category 1, for example, then we decided there should be no pension increases either pre-97 or post-97. For Category 2, we decided the post-97 increases should be equal to our RPI assumption of 4.05%. For Category 3, both pre- and post-97 increases were 4.05%. For Category 4, the pre-97 increases were 4.05%, and we decided the post-97 increases should be 4%. And for Category 5 members, both pre- and post-97 pension increases were equal to 4%. This is a graph showing how the members in each category are divided between actives, deferreds and pensioners. For Category 1 members, there are almost twice as many deferred members as actives and pensioners. For Category 2, there are well over twice as many active and deferred members than pensioners. And for Categories 3, 4 and 5, there are almost the same numbers of actives, deferreds and pensioners.
Now regarding assumptions and starting off with market trends. The UK economy is emerging slowly from recession, but growth is moderate and unemployment is high. The UK is facing inflation above the government's target of 2%, remaining above 3% for the whole of 2011, and UK debt has increased rapidly since 2007. However, the government has taken several steps to reduce the burden of government borrowing. These spending cuts and tax rises are likely to keep the economic recovery at a modest pace. The economy will grow by less than expected next year, but growth in 2012 will be better than predicted, the British Chambers of Commerce forecasts. This affects pension funds in many ways. A report into the pension fund performance has found that pension funds in the UK were able to achieve positive returns last year, and for the second year in a row, making an estimated weighted average return of 12.5% in 2010, despite problems in the economy. Pension funds battered by the financial crisis performed strongly last year after stock markets recovered in the wake of Greek debt crisis. Pension fund deficits, which have plagued final salary occupational schemes around the world, narrowed as assets in 13 largest pension markets hit a record high of $25.6 trillion, which is £16.4 trillion. The steep rise in assets should give pension savers some comfort that commitments to a guaranteed retirement income will be honoured, but experts pointed out that global asset liability ratio is still well down from its 1998 level. The first assumption concerns interest rates for pre-retirement and post-retirement funds. These are by most important figures in the derivation of funding levels and pension payouts. By studying historical data and long-term UK gilt interests, we were able to estimate our average. Also knowing that gilts were assumed to be risk-free, we've added a risk premium in arriving at 6.9% for both pre- and post-retirement. The second assumption to derive is inflation. This was found by taking an average of the RPI over the last 30 years. From this we found inflation to be 4.05%. We have planned to use an average of the previous 50 years. However, we found inflation from 1960 to 1980 to be significantly greater than over the last 30 years, which would have caused our inflation rate to be much higher. Salary growth is a third assumption necessary for an accurate valuation of a pension scheme. XYZ PLC clients that are the members of the private sector, therefore the derivation of salary growth is more difficult as different firms reward their employees in different ways, with higher salaries tending to get a larger percentage increases than those on basic salary. Generally speaking, employees receive an annual increase in salary in accordance to inflation, so as their real income does not decrease each year. Due to the current economic climate, we have derived that salary growth shall be 4.5%. For a proportion of members married, we have taken that after looking at the members of the scheme, we worked out the average of our members to be 49. Also, using current trends, it can be seen that the high proportion of UK population are married, and also that wives are generally 3 years younger than their husbands. In relation to this information, we thought it was appropriate to use the assumption for a proportion married to be 80% males and 70% females. The final assumption concerns the appropriate mortality tables to be used in the valuation. These determine how long we will be paying a pension for by illustrating the expected lifetime of our members. For both mortality pre and post-retirement for non-pensioners and pensioners, that is, we used PMA 92 base and PFA 93 base. Here's a table of our liabilities matched against our assets. The value of assets and liabilities were based upon the assumptions mentioned previously, and then the calculations came out as you can see there. There's a deficit of just over 13.5 million and the funding level of almost 85%. The liabilities are fairly well covered by the assets, but in order to achieve a funding level of 100%, additional contributions must be made to the scheme over the next 10 years. Additional annual contributions of 118,858 by the employer are necessary to bring the funding level to 100%. Here you can see a graph which shows our proposed asset allocation. The audited accounts for XYZ since the previous valuation were provided. The scheme holds assets with a market value of 75 million as at the valuation date of the 5th of April 2010. Of the 75 million, 100% of these assets were funded by equities as opposed to investment in gilts and bonds, which is not expected to provide a higher return. Over 100% investment in equities is not regarded as a prudent investment choice, with the market price depending upon a wide range of economic factors, primarily government policy decisions related to the interest rates and inflation. Equities form the most volatile type of security available to an investor. This may result in greater variation in the value of assets of the scheme and consequently cause significant changes in the scheme's funding level. In order to minimise the risk of the portfolio, we have to propose an alternative asset allocation as shown in the chart. 50% of assets will be invested in bonds, and more specifically 30% in gilts and 20% in corporate bonds. Gilts are assumed to be risk-free, that is, they have no default risk. Corporate bonds are those issued by companies, and they're assumed to have comparable risk attributes to gilts, provided they're invested in reputable organisations. In this case, only AA-rated corporate bonds will be chosen. Both of these classes of bonds possess significantly less risk than any equity investment, and so offset the increased risk attached to the other 50% of the portfolio. This remaining 50% is split between UK equities and overseas equities, both of which possess greater uncertainty but a greater expected return. This process of diversification, that is, the inclusion of a variety of assets to reduce the risk of the portfolio, should provide a more consistent asset performance. Increased reliability and return received on the assets should create a stronger position for the XYZ scheme and a lower level of funding.
The liabilities that we have produced for the scheme are sensitive to the assumptions that we made. Therefore, it is necessary to modify these assumptions and analyse the changes which occur. The liabilities for active and deferred members are particularly sensitive to the interest rate. In order to analyse the sensitivity change, we adjusted our 6.9 interest rate by plus or minus 5% and included a 0% rate for comparison. These results are shown in the graph. As you can see, whenever it's adjusted by plus 0.5%, that both active and deferred members goes down. This goes down by minus 6% for actives and minus 7% for deferreds. But however, the pensioner stays the same. Whenever it's then decreased by 0.5%, the liabilities for actives and deferred goes up, and again the pensioner stays the same. The largest increase is whenever there is a 0% rate comparison. As you can see, the interest rate for active members increases by almost 200%, and for deferreds increases by 250%, and again pensioners remains the same. Inflation rate only affects the deferred members, as the active member's salary increase already incorporates the inflation rate. To analyse the effect of changing the interest rate, we again adjusted the rate by plus or minus 0.5% and included a 0% comparison. The graph shows the results. Whenever it is minus 0.5%, again the deferred members has gone down. This goes down by 7%. Whenever we add it 0.5% on, this goes up. This then increases by 8.25%. And when there has been a 0% increase, 0% rate, then this is decreased by almost 50%. Salary growth only affects members that are still in the business, as they have to adjust for the yearly salary increases. This means that it will only affect the active members. To analyse this, we again alter our 4.5% salary rate to plus or minus 0.5% and reduce the salary growth to 0% for comparison. These results are shown in the graph. When the salary growth is reduced by 0.5%, there's a decrease in the liabilities for actives by 6.1%. Whenever it is increased by 0.5%, there is then an increase in the liabilities by 6.62%. When this is reduced to 0% for the salary growth, there's a larger decrease in the actives liabilities. This decreases by 40%. Using our predetermined assumptions, the XYZ pension scheme has liabilities of over 41 million with respect to active members, 8.3 million relating to deferred members, and over 45 million for pensioners. We have decided upon 3 ways that we can improve our pension scheme's funding level by reducing the liabilities. The first factor we targeted for the investigation was the removal of pre-retirement revaluation. By excluding this revaluation, we calculate a total cost savings of 24.5 million. This can be shown from the graph. The savings include 19.8 million for active members and 4.7 million for deferred members. This process only affects our liabilities for actives and deferreds, since it removes the effect of inflation in the years prior to retirement, so this has no effect on the liabilities of pensioners. The second factor we decided to change in order to determine how much the liabilities would be affected is the accrual rate. Initially, we assumed that the accrual rate to be 1/60th. By changing this rate to 1/80th in our calculations for the active members, we reduced the scheme's liabilities by over 32 million from the original 41 million. Our total cost saving here is 9 million. This can be shown from the table. The final method we used was to apply 0% increases to all future pension payments, which involve recalculating the pension pre- and post-1997 individually, depending on whether the individual member was currently receiving 0% RPI or 4% increases, depending on the category they belong to. When we did this, it has a major impact on the liabilities for all members, reducing the actives liabilities by over 27 million, the deferred liabilities to under 7 million, and the pensioners' liabilities to just over 31 million. According to our calculations, it was the introduction of the 0% pension increase for all members which had the greatest effect of reducing the liabilities of the scheme, with a total cost saving of over 30 million. Thank you for listening to our pension scheme, and we will now take any questions.